Let's discuss the Federal Reserve System. Our goal for this lesson are to describe the three ways that the Federal Reserve System manages the country's money supply. Look at your vocabulary words. Banking service, where a customer can write checks against the money he has available in his name, is checking. For-profit banks open to the public for saving accounts, loans, and other financial activity is a commercial bank. A governmental regulation, a mandate which is instituted to safeguard the purchaser, are consumer protection laws. Federal Reserve set interest rate to determine the amount needed to pay back the loan is discount rate. Central banking system of the United States, duties include a watchdog role in regulation of banks, is the Federal Reserve System. A government investment in businesses guaranteeing repayments are government securities. Purchase or sale of government securities regulates the money that banks can lend, are open market operations. Money the Fed needs to have as a balance. Change determines amounts banks repay or retain, are reserve requirements. Banking service in which a customer is awarded interest on time he has kept money in that bank is savings. If you have done business in a local bank recently, you may have noticed the sign referring to the Federal Reserve System. Perhaps upon opening up an account for checking or saving, some of the information you were given made mention to the Fed as it is known. What exactly is the national government doing in the business of banking? The federal government oversees America's banking system. Okay, in your notes, go ahead and write today's dates. The Federal Reserve System performs a number of services that can take care of the customer's financial well-being in banking. Okay, so the Federal Reserve System The Federal Reserve System is the central bank of the United States. Okay, so the central bank of the United States. Congress created the Federal Reserve, giving it the responsibility to oversee and enforce a sound banking system and a healthy economy. This is the goal of the Fed as it is known in its entirety. The 12 Federal Reserve banks nationwide, each serving a specific region in the country, and the Board of Governors in Washington, D.C., set up to oversee the federal system. Okay, so it oversees and enforces a sound banking system. So its goal is to oversee and enforce a sound banking system and a healthy economy. This is the goal of the Fed as it is known in its entirety. Okay, the Fed serves as a banker's bank as well as the United States government's bank. The Fed also is a regulator of financial institutions and performs functions that affect the economy, the financial system, and each citizen in the U.S. The Fed creates rules that govern the actions of financial institutions. The Fed also checks and oversees institutions to make sure that they comply with Fed's rules. Okay, so they do a lot of things here. They, let's see, creates rules that governs the actions of federal institutions. So it governs the actions of financial institutions. It also checks and oversees institutions to make sure they comply with the federal rules. So it ensures that they comply The Fed also checks and oversees institutions to make sure they comply with the Fed's rules. The Fed's district banks are responsible for overseeing district bank holding companies who own one or more banks, and state member banks that are chartered by the state and are members of the Federal Reserve System. Okay, so the Federal Reserve System is the central bank of the U.S. Its goal is to oversee and enforce a sound banking system and a healthy economy. It governs the actions of financial institutions and ensures that they comply. Okay, the Fed looks out for the public. Okay. The Fed looks out for the public. The Federal Reserve also rules on applications from banks who want to merge. It also rules on bank holding companies who want to buy a bank. The Fed seeks the best for the community, even in making laws like the Truth in Lending, Equal Credit Opportunity, and Home Mortgage Disclosure laws. The Fed Reserve helps banks as a lender of last resort. A bank might be seeing a hard pull on its deposits, so it borrows from the Fed Reserve Bank. This loan from the Fed helps the bank handle temporary problems that might spread to other banks. Okay. So some situations it decides if banks can merge. It decides if banks can buy a bank. For example, we just had Home National Bank sell out to RCB Bank. That was something that that was one of the things that the Fed did. The Feds also lend money to banks. It lends money to banks. You go in the bank and you see the guarantee. If you put money in the bank, banks guarantee up to, is it $10,000 or $1 million? That means that if that bank closed down, the Fed Reserves backs that up. It guarantees that if you have that money in the bank, even if the bank closes down, that the federal government will honor that. They'll make sure that you get your money back up to so much money. In 1913, Congress saw the need for regulation of the banking system in the United States. There were concerns about providing a currency that would work well in our nation, so the Federal Reserve System was established. Through the early part of the century, Congress has added important laws to help the Federal Reserve System work toward the economic balance of this country. Okay, so in 1913, we had a need. We needed a currency that would work well in our nation. So we need a common currency in our nation. And this is when the Federal Reserve System was established. Okay. The Federal Reserve System has the authority to expand credit in case of a national emergency. Okay, it expands credit in a national emergency. It sets limits on the reserve. Okay, it sets limits on the reserve. Okay, so some of the things the Fed looks out for the public, it decides if banks can merge, if banks can buy a bank, and it lends money to banks. We said it was established in 1913 because we needed a currency in our nation. The Federal Reserve System expands credit in national emergencies. It sets limits on reserves. And we said that it manages America's supply of money. So it manages supply of money in the United States. Each of the 12 reserve banks serves the financial institutions who in turn provide services to businesses and individuals. In doing this, the Fed oversees the payment system, which is a necessary channel through which all financial transactions in the economy must travel. Every day, the Federal Reserve System processes millions of payments. These are in the form of both paper checks and electronic transfers. More than one-third of the checks written in the United States are processed by the 12 Federal Reserve Banks, totaling more than $12 trillion annually. The Federal Reserve System's electronic network handles almost $200 trillion each year, much more than America's annual gross national product. It is highly likely that when you cash a check or have money electronically transferred, a Federal Reserve Bank handles the transfer of funds from one financial institution to another in its Federal Reserve District. Each of the federal banks offers this on a fee basis to financial institutions who want to take advantage of their service. Okay. It oversees the payment system. It oversees the payment system. So basically, the Fed is in control of the money, of the flow of money. The Fed, okay, now wait a minute. The other thing, we said that there are 12 Fed Reserve banks. We need to put that in here. There are 12 Fed Reserve banks. Okay, the Fed is an important agency. The Fed is an independent agency of the United States government. Not only is it a watchdog for the nation's economic reserve, but the Fed also provides financial services to the government and commercial banks of America. It is the national banking system of the United States, having 12 districts across the country. These districts divide the 50 states into sections. For example, one region covers Montana, North Dakota, South Dakota, Minnesota, and parts of Wisconsin and Michigan. Each district has a Federal Reserve Bank. Okay. I probably should have put that over here. Alright. There are also 25 Federal Reserve branch banks throughout the country, in which the Federal Reserve region, the Federal Reserve Bank, is located in San Francisco, with branches located in Seattle, Portland, Salt Lake City, and Los Angeles. So there's 12 Federal Reserve banks. Each has its own district. It actually works as a government bank as well as a banker's bank. The nation's largest banking customer, the United States government, needs the help of the Fed. So it's a government bank. So over here, I'm going to put government bank. And the U.S. is its largest customer. The work the Fed does results in financial transactions involving trillions of dollars. The United States Treasury keeps a checking account with the Federal Reserve. The Treasury acts just like a customer with an account, giving incoming federal tax deposits and seeing outgoing government payments. The Fed is also in charge of selling and redeeming U.S. government securities such as savings bonds, Treasury bills, notes, and bonds. Okay. Okay. The U.S. Treasury U.S. Treasury keeps a checking account with the Federal Reserve. Keeps a checking account with the Federal Reserve. Okay. So the U.S. Treasury acts just like a customer with an account. The U.S. Treasury acts like a customer with an account. That means they make deposits and they make withdrawals. The Fed is also in charge of selling and redeeming U.S. government securities. Okay. Okay, so the Fed sells and redeems government securities like savings bonds. Okay. Government securities. And that's savings bonds and treasury bills, notes, and bonds. Okay, savings bonds. Treasury bills. Okay. So, now that we know what the Fed is, what the Federal Reserve System is, let's talk about how it manages the country's money supply. It says, okay, the Fed manages the money supply in 3 ways. A board of governors and a federal open market committee oversees the operation of the Fed. They are assisted by the Federal Advisory Council and the Consumer Advisory Council. These groups have different responsibilities within the organization, but overall the Fed has a threefold workload to influence the flow of credit and money in the United States. The first way the Fed works is through the open market operations. Okay, so the first way is open market operations. This is the purchase or sale of government securities. Okay, purchase or sale of government securities. By selling or buying these securities, the Fed can regulate the amount of money available to banks for lending. This is a very fine-tuned action to offset inflation or recession. A balance is needed to increase or decrease the flow of money and its availability so the spending does not either shut down completely or go wildly out of kilter. The finances of this country can change week by week, so the selling and buying of these securities help maintain equilibrium. Okay. Another way the Fed stabilizes America's economy is by changing the discount rate. Okay. So the second way is by changing the discount rate. When banks borrow money from a Federal Reserve Bank, they are given a certain interest rate to pay back the loan. If the Federal Reserve System raises the rate of interest, the banks find it harder to repay loans. This slows down the flow of credit in the economy. However, if the rate is lower, the bank can lend money and the flow of credit and money opens up. So banks borrow money from the Federal Reserve Bank So they borrow money from the Fed. The Fed charges interest. And it's this interest that they're talking about, changing the discount rate. If the economy is going too slow, they can lower it. If the economy is going too fast, they can raise it. So it's an attempt to control the economy. Okay? So the Fed manages money supply in three ways. One way is open market operations, the purchase or sale of government securities. The second is changing the discount rate. Banks borrow money from the Federal Reserve System. The Fed charges interest. Okay, so let's see what this third way is. The third way the Fed works is by changing reserve requirements. Okay, number 3. Changing reserve requirements. Practically any institution that takes deposits from people must set aside a certain percentage of deposits for its own currency and for deposits made back to the Federal Reserve Bank. Say First Bank of Lake Knoxville has been taking deposits and has an amount set aside for actually doing business with customers, making change, cashing checks, and also for paying back some loans to the Federal Reserve Bank. It has some left over to make loans to local citizens and local businesses. The reserve requirement by the Fed gives the amount that the First Bank must set aside. Now some new businesses in town need to get some loans in order to expand. The First Bank of Lake Knoxville does not have enough for all the businesses. However, it discovers that the Fed has lowered the requirement of money it must keep in the reserve. So the First Bank has more money freed up to lend the businesses. Okay, so there's a certain amount that banks have to have in the bank at night. Whenever not necessarily at night, but at night is when they check. but the feds require that there's so much money in the bank. Okay? And if the federal government lowers the requirements, that means that there's less money that has to be there, so you can use the rest of it for whatever. Okay, so let me reword this. Banks are required to keep a certain balance and that's basically what that's talking about. So one way that the Fed manages the country's money supply is by changing this requirement. Okay? The Federal Reserve System also works alongside the United States Treasury in putting new coins and currency in circulation. The Fed does this by issuing currency to banks. The Fed issues the nation's coin and paper currency. The United States Treasury, through its Bureau of the Mint and Bureau of Engraving and Printing, produces the nation's dollar and coin supply. The Fed banks distribute the cash to financial institutions. As the currency works its way back to the federal banks, it is checked for wear and tear and scrutinized for counterfeits. If the money is still in pretty good condition, it goes back into circulation as banks and other institutions order new currency. Worn out bills usually have a life of 18 months, are destroyed. The Fed is also an enforcer of consumer protection laws and reviews the operation of state member banks. It works to keep the balance of financial strength at a good level by keeping interest rates low in recessions and letting them rise in economic boom times. Okay. So the Fed, I'm going to call it the Fed, which you know by now is the Federal Reserve System. That's what Fed means. Puts new coins and currency in circulation. Okay, the Fed and the U.S. Treasury, they work together. Puts new coins and currency in circulation. Okay, and how they do this, okay, let's do it this way. Okay, money goes to federal banks. We'll start there. Money goes to federal banks. Okay, when it gets to the federal banks, it's checked for wear and tear, so it's checked. It's checked for two things. Okay. One is wear and tear. And it says bills usually last about 18 months. Bills, the life of a bill is 18 months. The other thing it's checked for is counterfeits. Okay? Okay. Then it issues money back to the banks and other institutions. So it issues bills to banks and other financial institutions. Okay. So the Fed and U.S. Treasury puts new coins and currency in circulation. The money goes to federal banks where it is checked for wear and tear. It says bill's life is 18 months. And it also checks it for counterfeits. Then it issues bills to banks and other institutions. Okay, the other thing, we said that it enforces consumer protection laws. So the Fed enforces consumer protection laws. And it reviews the operations of state member banks. It works to keep the balance of financial strength at a good level by keeping interest rates low in recessions and letting them rise in economic boom times. Okay, so they're also in charge of interest rates. So they keep interest rates low in recessions when the businesses aren't doing as well. And they let them rise in boom times. Okay? I want you to go back and review your notes, review this lesson, and go ahead and answer the questions.